and get us kicked off. Welcome. Thank you all for joining us. For those of you I haven't met, my name is Sarah McDonald. I'm CEO of Life Science Cares. An honor to lead an organization that is driving so much collective philanthropy and collective impact in life science hubs across the country. I am thrilled to bring to folks today an incredible wealth of information. One of our board members and greatest champions and cheerleaders in our San Diego office, Rob Gaan, who in his day job outside of Life Science Cares is a financial advisor and a trusted colleague who is going to present a little bit on the impacts of changes coming to federal tax policy and things that folks might want to think about as we head towards end of year and beginning of next year. Before I turn it over to Rob, just ask folks to keep themselves muted if possible. Use the chat for questions, and I will turn it over to Rob. Take it away.
Thank you so much, Sarah. And I just wanted to say very quickly, thank you to Sarah and thank you to Life Science Cares National for all the support that you provide the affiliate chapters, which basically, gives us the ability to make all of our respective communities better for everybody. So again, appreciate you and thank you for having me on. Welcome, everyone. Thanks for joining today. Happy holidays. I am Rob Gaan. I am a certified financial planner, but as Sarah said, I'm also the finance chair for Life Science Cares San Diego. And what I'm going to do is just to start sharing my screen here. I put together a very, very brief PowerPoint. This is just a short primer on the One Big Beautiful Bill. We call it OB3 because One Big Beautiful Bill is just too long. So OB3 and the impacts that OB3 is going to have on charitable giving. And there may be some things here that you're going to want to consider before year end. There's still time to do some things. So I'll cover this right now. So let me make sure that this is working here. All right, how's that? So can you see my presentation?
That works.
Okay, great. Okay, good. So got to do this. This is purely for education purposes, everyone. If something here catches your eye and gives you some ideas for yourself, please talk to your financial professional or your tax person. All right. I'll start off by saying, when it comes to charitable deductions, the rules today are pretty simple. If you make a donation, you pretty much get to deduct it as long as you itemize. So that's the important concept here. In order to get a deduction for a charitable donation, you have to itemize. So if you're using the standard deduction, that doesn't apply. However, with regard to the new year, starting in 2026, there actually is going to be a small change for people that don't itemize. So if you do not itemize and you make donations, individuals can get a $1,000 above the line deduction, as well as married couples can get $2,000, or married filing jointly can get a $2,000 above the line deduction. So if people make small donations and don't itemize, they can still get a tax benefit for it. But the changes that really impact most people who do itemize and who do make charitable gifts and deduct them, there's going to be the institution of a floor or a hurdle. This is similar to medical deductions where the first X percent, 7.5% of your medical deductions aren't deductible, but if you have medical deductions above that, you can deduct those. Here, starting in January, there's going to be a 0.5% AGI floor. So the first few dollars of your donations won't be deductible, but everything above that 0.5% hurdle will be. I've got a slide here in a second that'll show you some of the numbers that may make this a little bit clearer, but I'm just going to go over the basic tenets here. So again, starting in January, there's going to be a floor for charitable deductions where the first 0.5% won't be deductible. And then in addition to that, there's now going to be a little bit of a cap in that for people who are in the highest tax bracket, so if you're in the 37% tax bracket, which I think for joint filers is taxable income of somewhere north of $750,000 a year. If you are in that top bracket, even though you're in the 37% bracket, all of your deductions, so not just not just your charitable deductions, but mortgage interest, if you can deduct state and local taxes, all of those deductions will be capped at 35%. So there's going to be a little bit of a haircut here on your ability to take advantage of your deductions here. There's going to be a 35% cap on all deductions. So again, I have a slide here that'll show you what this means in a second. So in looking at the changes for individuals, I think Congress was nibbling around the edges here, looking for some revenue. So they made some changes both by instituting a floor as well as putting a little bit of a cap on your ability to get a tax benefit from your gifts. All right. I think a bigger change relates to companies. And so currently, the limits for corporate donations are you can deduct everything you give up to 10% of your net income. And so that's pretty broad. Starting next year, there is going to likewise be a floor instituted for corporations. And I think this is going to really be more meaningful. So there's going to be a 1% of net income floor placed on the deductibility of charitable gifts from corporations starting next year. And so, depending on the nature of a corporation and how generous they are, that 1% may be a pretty big hurdle. Again, we'll cover this in a second when I show a slide. But this could impact giving by corporations, but I will talk about a few things on the back end here, some possible workarounds that we might consider if you are a corporation and you do make donations to charities. So again, starting next year, there's going to be a 1% of net income floor on the deductibility of your charitable gifts. The 10% ceiling still remains. All right, so let's take a quick look here at what this really means. So this is for individuals, 2025 versus 2026. Let's just say that you've got an adjusted gross income of $1 million and you're making a charitable gift of $100,000. So if that's the case this year, 2025, it's pretty straightforward. You're donating $100,000, you get to deduct $100,000, and your tax savings is $37,000, which is 37% of $100,000. But starting next year, that same donation, $100,000, is now subject to this floor. So 0.5% of $1 million is $5,000. So you're only able to deduct $95,000 even though you gave $100. And again, this cap here, even since if you're making $1 million, you're in that 37% bracket. Your deductibility of that gift is capped at 35%. So 95,000 at 35% is 33,250. So as you can see here, the differences between the 2 years, you're losing a few $1,000s of tax benefit by donating in 2026 versus 2025. So that's how it impacts individuals. Moving on to corporations, a little bit more dramatic. Say you've got a corporation with net income of $25 million and you make charitable gifts of $200,000. Well, today that $200,000 is fully deductible. But next year, the deductibility of the gift will be subject to that 1% floor. So, 1% of 25 million is $250,000. So even if you make a $200,000 gift next year, you won't be able to deduct that because it doesn't meet the floor. Only deductions in excess of the 1% only donations in excess of the 1% will be deductible for the corporation. All right, so those are the changes. Again, it's pretty straightforward, but what are the implications here? Strategies that one might consider, whether you're an individual or a corporation, is the concept of bunching. When it comes to deductions, if you have the ability to, if you can bunch your deductions in a particular tax year, you may find that you get more tax benefit from doing that. So this idea of bunching, as it applies to charitable donations, is there a way for you to bunch potentially several years, a couple or several years worth of donations into a single tax year, and then get a deduction, and then have the ability to use those donations in future years? A vehicle that does allow you to do that is something called the donor advised fund. So a donor advised fund is a public charity, and so if you make a donation to the donor advised fund, you can declare a deduction for that. But the beauty of a donor advised fund is that you now have a giving pot. You have an account here that has money in it that you can give away over time. You don't have to give it away right away. So conceptually here, if you're a regular giver and you know what your giving patterns are, maybe you potentially in 2025, because there's no limits here, there's no floors and there's no caps. Maybe you put 2 or 3 years worth of giving into the account now, get the deduction dollar for dollar, get the benefit, and then use that money over time. So that's the concept of bunching and utilizing a donor advised fund to be able to achieve that. When you think about your donations, not all donations are the same. I tell people, and nonprofit development officers hate when I say this. I tell them, don't give cash to nonprofits, and they freak out for a minute. But what I'm referring to is donating appreciated assets, because when you think about donation currency, donating appreciated assets may well be the best way to make donations, because you actually get a couple of tax benefits from it. And so an appreciated asset could be anything that you've held for more than a year. It could be a stock, it could be crypto, it could be real estate. Any asset that's gone up in value and that you've held for more than a year is donation capital or currency that you could use for a charity. And the benefit that you get is you do get a deduction equal to the fair market value of the asset that you contribute. So if you donate a stock that's worth $100,000, you get a deduction of $100,000. But in addition to that, again, if this asset is appreciated, you also give away the capital gain that's embedded in the asset. So if that $100,000 donation you only paid $50,000 for, well, that $50,000 capital gain, which you otherwise would have to pay taxes on if you sold the stock, you can now give that gain away to the charity. The charity could sell the stock, they get the full $100,000. They don't realize a capital gain because they're a nonprofit. So they get the money that they want. They get the full $100,000 that they need to operate. You've made that gift. You get the $100,000 deduction, and you've given away the capital gain. And if you like the stock, if it's Nvidia or something, you just can't can't give away. You can't have the idea of giving this great stock away. Well, the $100,000 that you otherwise would have written a check for, you can go buy the stock back and reset your basis and maintain the position, or use it as an opportunity to rebalance your portfolio. So again, when you think about giving, don't necessarily only think about gifting cash, think about gifting appreciated assets. All right, so we've gone through this pretty quickly. Again, conceptually, the the concepts are pretty straightforward. There's certainly, if you were planning to make a gift, there certainly are some opportunities here to take advantage of in 2025. Again, the numbers aren't dramatic, but it's real money. If you saw then my example, if you saw $4,000 sitting on the ground, you'd pick it up, right? So if there's an opportunity for you to take advantage of that by making the gift now, you should certainly take that advantage. And again, there are mechanisms that allow you to do that. From a corporate standpoint, one thing that I've been talking to with regard to nonprofits that I work with, as well as companies that I work with, as we look forward into the new year, keeping in mind that corporations likewise can open up donor advised funds. So donor advised funds are available to corporations if they want to use them. But I think that, or at least I'm recommending that companies and nonprofits have a discussion where they talk about the nature of their giving, because it's quite possible that you might be able to change the character of your contribution to something that would still allow the company to get some sort of tax benefit from it. So for example, instead of saying, hey, we're making a gift or we're making a donation to this nonprofit, maybe you can say, hey, we're sponsoring this event, and as a result, our name is going to appear in the programs. Maybe you can qualify that as being, put it under your marketing budget or your advertising budget. So there may be ways for you to change the character of your support for these nonprofits that still allow you to make contributions to these nonprofits and get a tax benefit from it, especially if the donations or the gifts that you're making to charities falls below this new 1% threshold. So those are ideas that I've been talking to companies and to nonprofits about. Have that discussion. How can we make this a deductible gift for the corporation by changing the character of the gift? So this is pretty quick. We've got some time for questions. Again, if anybody has any questions here, please feel free to ask them now.
Thanks, Rob. And yeah, if folks have questions, feel free to come off mute or put them in the chat and I can MC them. We do have a combination of Life Science Care's donors and supporters, as well as some of our nonprofit partners who I know are listening in to pass on some of this advice to donors of theirs as well. So feel free to leverage Rob's expertise.
And I'm jealous of all the people who already have their Christmas decorations up.
Fast forward to the one question. Any
Yep.
change in donating directly from an IRA, Rob?
Thank goodness no. So what you're referring to is something called the qualified charitable distribution. So if someone has an IRA and they are over age 70 and a half, so that's another qualification. So if you're over age 70 and a half and you have an IRA, you can make a gift directly to a nonprofit from your IRA. And while you don't get a deduction, you get something even better. You get the avoidance of income. And avoiding income is always a good thing. So conceptually, the qualified charitable distribution really works well for someone who's reached age 73 and has something called the required minimum distribution. So if you have a retirement account and it's been growing and it's been deferring all of these decades, you've never had to pay a penny of tax on the dividends, the interest, the capital gains. At age 73, the IRS says you've got to start taking money out of that account so we can start collecting some tax revenue. Well, at that point in time, you're forced to take money out of your IRA, and in a sense, you're forced to recognize taxable income on your tax return. But if you're charitably inclined, you can redirect a portion or all of that required minimum distribution. There is a cap, it's $100,000 per year, but you can redirect that required minimum distribution to a charity or charities of your choice. You satisfy your required minimum distribution, but you don't have to report the income. So it's a way for you to be charitable and to get an absolute tax benefit from it. The great news is that was not changed as a result of OB3. That strategy is still available.
I have a question. Well, I have two questions. One is, how would you best go about sort of sharing this information with funders, whether it's like individual donors? Is there a way to sort of like start to sort of say, hey, did you know that with with a DAF you could do this, but then like link them toward where they could find more information? Um, and also, I'm just wondering what you anticipate, like where do you think, because I'm sort of thinking like, will major funders be as impacted as corporations? Like I'm thinking about, where if you were just looking for like in the next, few years, do you think it will significantly impact charitable giving?
I've read some articles that make me concerned.
Mhm.
Um, my personal experience has been the individuals that I work with who donate, they donate because they're passionate about the cause. And listen, no one's going to pass up a tax benefit, but I think the motivation is to support the cause. And so my hope that continues. Again, for individuals, the impact is minor, right? Again, the thousands of dollars here and there are real money, but my hope is that the donors will continue to be supportive simply because they're passionate about what they're doing and supporting.
Okay.
Um, but I have read reports that again give me pause. Ernst Young, and I forgot the number, but it's big. It was in the billions. Ernst Young Consulting did a quick study, and they thought that there could be a multi-billion-dollar impact on giving, especially from at the corporate level over the next few years, and that's frightening to me. But again, my hope is that people will be well. To answer your first question, I would open a dialogue. Even did you know about this? Will start the conversation. You could, at the very simply, just direct them to this video, and maybe they can come up with ideas for that. But I would just start the conversation with people, and just say, hey, there's some changes here. Whether you're a corporation or an individual, let's talk and see how we can allow you to continue to support, but at the same time give you the most benefit that can possibly be available to you.
Thank you.
Yeah,
Thank you.
if folks didn't see it, I just put in the chat too. Life Science Cares will share the slides and a recording from this session with folks. And Rob, I don't think you have a problem with that being shared beyond our direct universe to
No,
our
I'm
partners
trying to
universe
get
as
viral
well.
here, so go ahead, let's do it.
Tax advice goes viral. We will be the first folks. Tax education, not advice, will
That's
go
right.
viral. I'll say too, I was at a presentation earlier this morning around Bank of America does an annual Trends in Philanthropy report. And to the question of what motivates folks to give, the number one and number two reasons by far, like multiples of the stuff further down the list, are personal values, personal belief, or personal experience or engagement with an organization. The tax benefits were much further down the list and often only come into account when the donor has already decided they're going to give. They might ask, how do I do this in the most tax efficient or effective way? But often not the only deciding. And that applies to individuals. Rob, I appreciated your suggestions and kind of thoughts about the other mechanisms in a corporate budget where nonprofit partnerships are actually driving a lot of value and how to think about approaching companies with an ask that's not just charitable tax deduction, but also talking about all the other benefits our work together brings. Awesome. Any other questions from folks? And I will share out to everyone here the link to the session, the link to slides as soon as they're all processed through whatever Zoom magic happens. And I'll get them on our website too, so you could share to your stakeholders if that's helpful. I want to thank you all for joining us. This is something new for us as Life Science Cares is really trying to think about all the ways we might add resource or value to our partnerships with our donors and stakeholders and volunteers and our nonprofit partners. Appreciate you guys joining and look forward to seeing you in the last couple of weeks of the year. If you have any questions about a gift to Life Science Cares, don't hesitate to reach out. We've got the team standing by to make sure that we can meet your goals and really achieve the shared mission we're coming together around. Thank you all.
Thank you. Thank you so
Thanks,
much,
Rob.
Rob. Thank
Very
you.
welcome. Happy holidays, everyone.
Happy holidays.